China sold a record amount of stocks, $5.1 billion in the month of August.
Hold on, this is not a drill. China just triggered the financial world's worst nightmare, dumping U.S. debt. In the last 48 hours, top analysts and economists are sounding the alarm. Beijing is quietly liquidating its massive holdings of U.S. Treasuries. And this isn't just a financial decision, it's a declaration of war on the U.S. dollar. Let's break this down. As of July 2025, China holds roughly $770 billion in U.S. Treasuries. That's still a huge pile, but it used to be over $1.3 trillion just a few years ago. Why the drop? It's strategic. China is distancing itself from the dollar. And now, with trade tensions surging and tariffs flying, Beijing is accelerating that exit. The People's Bank of China has reduced purchases for 4 consecutive quarters, and now, reports from Reuters and Bloomberg confirm that Beijing is offloading bonds on the secondary market, quietly, calculated. What does that mean? It means China is sending a clear message to Washington: we won't fund your deficits forever. And that threat is working. In the past 48 hours, bond yields have spiked. The 10-year yield jumped to 5.1%, the highest since 2007. Investors are rattled. Wall Street is down, and the dollar is trembling. But here's the twist: China doesn't want to crash the dollar completely. That would hurt them too. But what they do want is leverage, influence, power. See, Treasuries are America's lifeline. The U.S. is running a $2 trillion deficit this year. Every minute the government borrows over $4 million. And who funds that? Foreign investors. But if China and others step back, the Fed will be forced to print even more money. Inflation will surge, interest rates will climb, recession becomes almost guaranteed. Sound dramatic? Let's look at the numbers. In March 2025 alone, China slashed $45 billion from its bond portfolio. Japan followed suit with $17 billion. Saudi Arabia's cuts were quieter, but visible. And now, BRICS countries are discussing a plan to completely de-dollarize sovereign reserves. Brazil, Russia, and South Africa have reallocated a combined $120 billion into gold and euro-based bonds. This isn't theoretical, it's happening right now. Meanwhile, Washington is doubling down on isolation. Trump's 125% tariffs on Chinese goods, announced July 25th, have only worsened the situation. In response, Beijing declared a de-dollarization emergency protocol, which includes cutting new treasury purchases and exploring direct bilateral trade with oil-exporting nations in yuan. Let's talk consequences. The bond market is the backbone of the global economy. If investors lose faith in treasuries, everything breaks. Mortgage rates, they're already pushing 8%. Credit card APRs, past 24%, corporate borrowing costs, exploding. Small businesses, students, car buyers, everyone suffers, and that's just the domestic side. Globally, developing nations who hold dollar reserves are now hedging with gold, Bitcoin, and even digital yuan. The IMF warned this week a coordinated foreign sell-off could destabilize sovereign debt markets. Translation: if China keeps selling, America's credit rating could be next on the chopping block. Here's a brutal irony: the US once used treasuries as soft power. But now, they're turning into a liability. Beijing sees that, so do others. Jeffrey Gundlach, billionaire bond king, said it best this week: "Sell America is in full force." He warned that the U.S. is entering a debt spiral. With interest on debt nearing $1 trillion annually and tax revenues stagnating, the math just doesn't work. Foreigners are watching and exiting. So, what now? The Fed is stuck. Raise rates, and they crash housing and stocks, cut rates, and inflation explodes. Meanwhile, foreign governments are acting independently. The UAE just inked a 30-year oil for gold contract with China, no dollars involved. India's central bank announced it will slash dollar reserves by 40% over the next 18 months. Even France is experimenting with direct yuan settlements for luxury goods. This is a paradigm shift. The dollar's dominance has lasted since World War II, but cracks are forming. It's not just about China, it's a global rebalancing. A push for multipolar finance, and America's biggest advantage, faith in its debt, is fading. Now, let's get practical. What does this mean for you? If you live in the US, your cost of living is likely going to rise. Imported goods will become more expensive, interest rates on mortgages and loans will remain high. If you're investing, watch the bond market like a hawk. If China accelerates its sell-off, Treasury prices could plummet and bond funds will suffer. If you're outside the US, this is your wake-up call. Diversify your reserves, stay alert to currency volatility. And understand, the world is changing, the scariest part. Most Americans aren't even aware this is happening. The news cycle is distracted by elections, celebrity scandals, and domestic drama. But the real battle, the one that decides your financial future, is being fought in bond markets, central banks, and foreign ministries. Let's dive deeper into the latest developments as of July 27, 2025, 9:04 a.m. CEST. Over the past 48 hours, the financial landscape has shifted dramatically. Reports from Bloomberg indicate that China's latest treasury sell-off, estimated at $10 billion since July 25, has coincided with a sharp rise in gold prices, now hovering around $2,600 per ounce, a 4% jump in a week. This move aligns with China's aggressive gold accumulation, with the People's Bank of China adding another 20 tons to its reserves in June 2025 alone, pushing its total gold holdings past $250 billion. Analysts suggest this is a deliberate hedge against dollar volatility, a trend reinforced by posts found on X where users note China's pivot as a strategic masterstroke. Meanwhile, the U.S. Treasury Department released preliminary data yesterday, confirming that foreign holdings of treasuries dropped by $55 billion in June 2025, with China accounting for nearly 20% of that decline. This follows a pattern seen earlier in the year, with April 2025 seeing an $8.2 billion reduction and May 2025 a $900 million cut, as reported by the Treasury. The cumulative effect is a 3.5% drop in China's holdings over 6 months, signaling a sustained strategy rather than a one-off reaction. The ripple effects are immediate. The U.S. 30-year Treasury yield hit 5.3% this morning, the highest in nearly 2 decades, prompting a sell-off in U.S. equities. The S&P 500 fell to 0.1% in pre-market trading. Mortgage applications dropped 15% week over week, according to the Mortgage Bankers Association, as rates approach 8.5%. Globally, the euro strengthened against the dollar by 1.2%, while the yuan gained 0.8%, reflecting growing confidence in alternative currencies. On the geopolitical front, a Reuters report from yesterday highlights a closed-door meeting in Beijing, where Chinese officials discussed accelerating de-dollarization with Russia and India. The trio is exploring a BRICS-led payment system using a basket of currencies, potentially launching a pilot by Q1 2026. This comes as Russia's central bank reported a 25% reduction in dollar-denominated assets since January 2025, mirroring China's moves. Back in the U.S., the Federal Reserve is under pressure. Fed Chair Jerome Powell hinted in a statement late Friday that all options are on the table, including emergency rate hikes to defend the dollar. However, this risks triggering a recession, with Goldman Sachs forecasting a 1.2% GDP contraction in 2026 if yields stay above 5%. The Fed's balance sheet, already strained from $43.6 billion in Treasury purchases in May, may need to expand further, fueling inflation fears. Consumer prices rose 0.4% in June, pushing the annual rate to 6.9%. Internationally, the IMF updated its global outlook, cutting growth forecasts to 2.8% for 2025. Citing unprecedented currency realignment risks, the World Bank echoed this, warning that emerging markets could face a $300 billion funding gap if Treasury demand collapses. In response, countries like South Korea and Mexico are increasing gold reserves by 10% and 15%, respectively, while the European Central Bank is considering a Eurozone bond issuance to counter dollar weakness. The data paints a stark picture. China's sell-off isn't just about tariffs, it's about redefining global finance. A CNBC analysis this morning noted that if China offloads another $50 billion by year-end, the U.S. could face a 50 basis point yield spike, adding to $100 billion to annual interest costs. This would push the debt-to-GDP ratio past 130%, a level not seen since World War II. On X, sentiment is heated. Users are debating whether this is China's economic checkmate or a bluff that could backfire if the yuan strengthens too much. Some point to Japan's silence. Its $1.1 trillion in treasuries remain stable for now, but others speculate Tokyo might follow suit if U.S. rates keep rising. For investors, the stakes are high. BlackRock's latest report advises shifting 20% of portfolios into gold and European bonds, citing unprecedented uncertainty. Hedge funds are shorting the dollar, with open interest in USD futures dropping 8% since July 25th. Retail investors, however, are split. Some are panic buying gold, while others cling to U.S. stocks, hoping for a Fed rescue. Final question. Is it too late to stop this? Maybe, maybe not. If Washington acts fast, stabilizes spending, reduces deficits, restores global confidence, there's a chance. But if the political chaos continues, if tariffs escalate, debt keeps growing, and diplomacy collapses, then yes, this might be the beginning of the end for the dollar's reign. So, what do you think? Is China bluffing, or is this a calculated strike on U.S. dominance? Drop your thoughts in the comments, like if you learned something new, and subscribe because this story isn't over. We'll see you in the next one.